Prologue, the top 1% of the 1%. In the last century, millions of people have tried to extract wealth from the stock market. Most broke even. Many lost everything. A small percentage did well. But then, there are the masters. Hi everyone, welcome back to Book Summary YT. In 1980, a man named John Train did something extraordinary. He didn't just write a book about how to invest. He went out and interviewed the 9 most successful investors who had ever lived up to that point. He sat with them. He studied their portfolios. He analyzed their psychology. The result was the book The Money Masters. This book is not a get-rich-quick guide. It is a collection of 9 distinct philosophies that have withstood wars, depressions, inflation, and crashes. Today, we are not just summarizing this book. We are going to deconstruct it. We are going to look at the specific trades, the mathematical models, and the mental frameworks of all 9 masters. We are going to see why Warren Buffett considers this one of the most important books ever written. Get comfortable. This is the complete story of the Money Masters. Chapter 1. The Sage of Omaha, Warren Buffett. John Train begins his book with a man who, at the time of writing, was a recluse. He worked from a small office in Omaha, detached from the noise of New York. Train describes Buffett not as a stock picker, but as a purely rational allocation machine. To understand Buffett, you have to understand the 2 phases of his career described in the book. Phase 1 was the Graham phase. Buffett bought companies that were statistically cheap, what they called cigar butts. They were terrible businesses, but they were selling for less than the cash in their bank accounts. But the Money Masters highlights the crucial pivot to Phase 2, the franchise phase. Buffett realized that the greatest wealth is created by franchises. A franchise is a business with a moat. Train explains that a business with a moat can raise prices without losing customers. Buffett gives the example of a newspaper in the 1970s. If you are the only newspaper in town, you have an unregulated toll bridge. Advertisers must pay you to reach customers. You have pricing power. Train details Buffett's strict criteria for a purchase. He must understand the business circle of competence. The business must have favorable long-term prospects. It must be operated by honest and competent people. It must be available at a very attractive price. Train emphasizes Buffett's concept of the punch card. Imagine you were given a punch card with only 20 slots. Every time you make an investment, you punch a hole. Once the 20 slots are gone, you can never invest again. Buffett operates as if this card is real. He ignores 99.9% of opportunities to wait for the fat pitch. Key insight: the market is a relocation center for money, moving it from the active to the patient. Buffett is the ultimate patient man. The father of value, Benjamin Graham. If Buffett is the prodigy, Benjamin Graham is the professor. John Train dedicates this chapter to the man who invented the profession of security analysis. Before Graham, Wall Street was a casino. People bought stocks because they were going up. Graham introduced the concept of intrinsic value. Graham's approach was purely quantitative. He didn't care about the CEO's personality. He looked for the net. A net is a company that is trading for less than its current assets minus all liabilities. Effectively, you are buying the company for nothing and getting the buildings and machinery for free. But Graham's greatest contribution in the Money Masters isn't the math, it's the psychology. We must talk about Mr. Market. Train explains Graham's allegory. Imagine you own a business with a partner named Mr. Market. Mr. Market is a manic depressive. On Monday, he is euphoric. He sees only sunshine. He offers to buy your share for $1,000. On Tuesday, he is terrified. He sees only rain. He offers to sell you his share for $200. The business hasn't changed. Only Mr. Market's mood has changed. Graham taught that the true investor does not look to the market for advice. He looks to the market only for opportunity. You use the market's erratic behavior to your advantage. You buy when he is depressed, and you sell when he is manic. Key insight: you are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Chapter 3. The Scuttlebutt Master, Philip Fisher. While Graham was buying cheap companies, Philip Fisher was buying great companies. Fisher is the father of growth investing. In The Money Masters, Train highlights how Fisher's method was the polar opposite of Graham's. Fisher didn't care about book value. He cared about future earnings. Fisher invented the scuttlebutt method. He believed that the official reports from a company were often sanitized marketing brochures. To find the truth, you had to dig. Fisher would talk to the company's competitors. What do they respect? What do they fear? Talk to suppliers. Do they pay their bills on time? Talk to former employees. Was the management honest? Fisher looked for the 15 points of a superior company. We won't list all 15, but the core pillars were R&D. Does the company spend money to develop new products before the old ones die? Sales organization. It's not enough to have a good product, can they actually sell it? Management integrity. When things go wrong, does management own up to it, or do they hide? Fisher was famous for holding periods that lasted decades. He bought Motorola in 1955 and held it until he died in 2004. He believed that if you did the work correctly, the time to sell a stock is almost never. Key insight: don't sell a winner just to take a profit. You can go broke taking small profits while missing the life-changing compounders. Chapter 4: The Global Contrarian, John Templeton. John Templeton was perhaps the most spiritual of the money masters. He lived in the Bahamas, far away from Wall Street, to keep his mind clear. Templeton was the pioneer of global investing. In the 1950s and 60s, American investors only bought American stocks. Templeton asked a simple question: if I only look at 50% of the world's companies, how can I find the best value? He looked at Japan when everyone else saw a bombed-out ruin. He found companies growing at 30% a year, trading at a P/E ratio of 3. He backed up the truck. When the world finally realized Japan was a superpower, Templeton was already rich. Train emphasizes Templeton's principle, the point of maximum pessimism. Templeton famously said, "To buy when others are despondently selling and to sell when others are greedily buying requires the greatest fortitude and pays the greatest reward." At the start of World War II, when panic was at its peak, Templeton borrowed money to buy every single stock on the NYSE trading under $1. He knew war would require efficiency and production. He turned a massive profit. Templeton looked for bargains everywhere. A bargain to him was a stock trading at 20% of its true value. He would hold it until it reached 80% of its value, then sell and find the next bargain. Key insight: if you do what everyone else does, you will get the same results as everyone else. To beat the market, you must be different, and you must be right. Chapter 5: The Visionary of Growth, T.WE Price. You recognize the name from the massive investment firm today, but T.WE Price was a real man with a radical idea, the growth stock theory. Before Price, stocks were seen as income vehicles, you bought them for dividends. Price realized that a company retaining its earnings to grow was more valuable than a company paying them out. Train explains Price's life cycle theory. Every company has 3 stages. Growth: the company grows faster than the economy. This is where you buy. Maturity: the company grows at the same pace as the economy. Decadence: the company loses market share and declines. Price wanted to own companies only in the first stage. But T.WE Price's most impressive feat in the Money Masters was his prediction of the inflation era. In the mid-1960s, while the Nifty 50 stocks were soaring, Price saw trouble. He saw government spending increasing. He predicted massive inflation. He sold the popular growth stocks and moved into hard assets, gold, silver, oil, and land. When the 1970s inflation crisis hit and the market crashed, T.WE Price's portfolio soared. Key insight: you must adapt. Price was a growth investor, but when the macro environment changed, he had the flexibility to become a resources investor. Chapter 6: The Pragmatic Proprietor, Larry Tisch. Larry Tisch, of Lowe's Corporation, represents the businessman investor. He wasn't playing the stock market, he was buying businesses. Train describes Tisch as the ultimate pragmatist. He didn't have a rigid formula like Graham. He simply looked for dislocations. Tisch was famous for sitting on cash. Immense amounts of cash. While other fund managers felt pressure to be fully invested, to earn their fees, Tisch would wait years for a deal. He believed that cash is an option. It is the price you pay for the freedom to strike when disaster happens. When Tisch bought a company, his first move was to cut the fat. He was ruthless about efficiency. He didn't believe in corporate jets or fancy headquarters. He believed that every dollar spent on overhead was a dollar stolen from the shareholders. Train notes that Tisch's genius was in recognizing that the market often prices a company based on its temporary problems, not its permanent assets. He would buy the assets at a discount, fix the management, and wait for the market to correct. Key insight: don't be afraid to hold cash. And when you buy, act like an owner, not a spectator. Chapter 7: The Brahmin of Boston, Paul Cabot. Paul Cabot managed the Harvard Endowment. He represents the institutional approach to investing. In the 1960s, Wall Street went crazy. It was the go-go years. Fund managers were buying concept stocks with no earnings, chasing trends. Cabot stood like a rock against this madness. Cabot's famous line in the book is, "Facts are better than dreams." He refused to speculate. He believed that the job of an investment manager was not to make the most money in 1 year, but to preserve capital for 50 years. Train uses Cabot to illustrate the importance of management quality. Cabot believed that you bet on the jockey, not the horse. If a company had a reliable, conservative management team, Cabot would stick with them through hard times. Key insight: boring is beautiful. In a world of speculators chasing the next big thing, the person who avoids major mistakes wins in the end. Chapter 8: The Short Seller, Robert Wilson. Now we enter the high-risk zone. Robert Wilson was a hedge fund manager famous for short selling. Most investors only play one side of the field, the long side. Wilson played both. He would buy great growth stocks, but he would also bet against terrible companies. Train dedicates this chapter to the psychology of risk. Short selling is terrifying because your losses are theoretically infinite. If you short a stock at $10 and it goes to $100, you are wiped out. Wilson famously got caught in a short squeeze with Resorts International. He bet against it, but the stock kept doubling. He lost millions. But, and this is the key, he survived. Wilson teaches us that to make outsized returns, you must be willing to look foolish. He had an incredibly high tolerance for pain. He knew that if he was right 60% of the time and managed his losses on the 40%, he would be rich. Train describes Wilson as having a fluid mind. He could change his opinion in a second if the facts changed. He had zero ego attached to his positions. Key insight: don't fall in love with your position. If the market tells you you are wrong, get out immediately. Chapter 9: The Commodities King, Stanley Kroll. The final master is the most distinct. Stanley Kroll didn't trade stocks. He traded commodities: wheat, sugar, copper, cocoa. This is the most volatile market on earth. Leverage is high. Fortunes are made and lost in minutes. Kroll was a trend follower. He didn't care about the value of wheat. He cared about the price action. Kroll's strategy was psychological warfare against himself. He knew that the biggest enemy in trading was the urge to do something. When Kroll entered a massive position on a trend, he would literally leave town. He would go on a cruise. He would disconnect his phone. Why? Because he knew that if he watched the daily fluctuations, he would get scared and sell. He needed to remove himself from the data to let the big trend work. He preached that gross profits don't matter, only net profits matter. And the only way to capture a massive net profit is to sit tight for the entire duration of a bull market, ignoring the shakes and wiggles along the way. Key insight: the big money is not in the buying and the selling, but in the waiting. Conclusion: the synthesis. When you read The Money Masters, you might initially be confused. Graham says buy cheap assets. Fisher says pay up for growth. Buffett holds forever. Wilson trades rapidly. Cabot wants stability. Kroll wants volatility. They seem to contradict each other. But John Train weaves them together into a single tapestry of truth. There are 3 things that every single one of these men shared. 1. They were obsessive. None of them treated this as a hobby. It was their life's work. They did the reading. They did the math. They put in the hours. 2. They had emotional discipline. Whether it was Templeton meditating, Kroll going on a cruise, or Buffett sitting in Omaha, they all built systems to insulate themselves from the madness of the crowd. They mastered their own fear and greed. 3. They were contrarians. You cannot beat the market by being the market. Every single master had the courage to stand alone when the world told them they were wrong. The lesson of the Money Masters is not to copy Warren Buffett or Stanley Kroll. It is to find the method that fits your psychology. If you are anxious, be a value investor like Graham. If you are a dreamer, be a growth investor like Fisher. If you have nerves of steel, follow Wilson. Find your game, learn the rules, and then play it better than anyone else. This has been the complete summary of John Train's The Money Masters. If you found value in this deep dive, consider subscribing. We are building a library of the greatest financial wisdom in history, one book at a time. Let me know in the comments, which master resonates with you the most. Are you a Graham or a Fisher? This is Book Summary YT, and I'll see you in the next chapter.